1.8 billion barrels. That is the number on the table this morning of 11th March. The International Energy Agency is proposing the largest coordinated release of emergency oil reserves in the 50-year history of the organization, a drawdown that would dwarf the 182 million barrels released when Russia invaded Ukraine in 2022. The IEA is not proposing to release a fraction of that. It is proposing to release 10 times that number. 1.8 billion barrels injected into a market that has been starved of supply for 12 consecutive days. That number is what this episode is about. And by the end, you will understand exactly what it means for your position in both oil and silver. Good evening. I'm James Harlow. Welcome to The Right Chapter, where we connect the world's biggest headlines to the assets that respond to them. Tonight we are running a dual asset episode because the G7 emergency meeting that drove today's market action affects oil and silver in ways that are connected, counterintuitive, and, once you understand the mechanism, deeply revealing about where both assets are heading from here. Let's start with what happened today, because the events of March 11th, 2026 are genuinely historic by any measure. The G7 leaders convened a video conference chaired by French President Emmanuel Macron, the first emergency economic summit of the conflict, now 12 days old. On the table, whether to authorize an immediate coordinated release of strategic petroleum reserves on a scale the world has never seen. By early afternoon European time, the shape of what was coming became clear. Japan's Prime Minister Takaichi announced independently, without waiting for formal G7 coordination, that Japan would begin releasing strategic reserves as early as March 16th. Germany's Economy and Energy Minister Katharina Reiche confirmed Germany was preparing to do the same. France confirmed that G7 energy ministers stood ready to take, in their exact words, all necessary measures. And the International Energy Agency, the 32-nation body that holds the Coordinated Reserve Authority, formally proposed to its member states a drawdown exceeding 182 million barrels. That figure, to be precise, is the proposed floor. The actual volume under discussion is closer to 300 to 400 million barrels, according to sources who briefed CNBC on Monday, or the equivalent of 25 to 30% of the total 1.2 billion barrel IEA reserve. To understand what this means mechanically, think of it this way. The global oil market right now is a swimming pool with the main water inlet, the Strait of Hormuz, almost completely blocked. The pool is emptying. The world's governments just decided to back up a tanker truck to the pool and start pumping from a reserve supply. The question is not whether the truck is large enough to fill the pool indefinitely. It is not. The U.S. Strategic Petroleum Reserve is itself significantly depleted from the Biden-era release in 2022, and analysts at Rapidan Energy have explicitly stated the SPR is insufficient on its own to offset the supply bottled into the Persian Gulf. The question is whether the truck is large enough to buy time, to keep the pool from emptying completely, while diplomacy, de-escalation, or military resolution reopens the inlet. The market's answer today, based on live price action, is a cautious yes. Brent crude is trading at approximately $88 per barrel this session, having bounced off Tuesday's low of $83.45 and holding below $92. WTI is at $85.15. Both benchmarks have been whipsawed by 11 to 12% in a single session and are now attempting to stabilize in the $85 to $90 range as the reserve release narrative takes hold. That range, $85 to $90, is the market pricing in a managed disruption scenario rather than a catastrophic one. It is pricing in the truck. Now let's talk about silver, because here is where today's story becomes genuinely interesting and where most of the financial media coverage has completely missed the point. Silver is trading at $88.28 per ounce this morning, rebounding sharply after 3 consecutive sessions of losses. It is up today. The IEA reserve release news helped it, and yet silver is still the single worst performing major asset class since the Iran war began on February 28th. Gold is down approximately 7% from its war-era high. Oil, despite the 12% crash this week, is still up roughly 20% from pre-war levels. Silver peaked at $95.85 in the first days of the conflict and crashed 19% to $79.50 before this recovery. Of every major asset class, stocks, bonds, gold, oil, industrial metals, silver fell the most. A war in the world's most oil-rich region, a global industrial supply disruption, a monetary shock, and silver was hit the hardest. That headline seems to make no sense at all. Tonight I want to show you exactly why it does make sense, and why understanding it correctly is the most important analytical task in precious metals right now. Here is the mechanism. Silver is not one asset. It is two assets wearing the same price tag. Approximately 53% of annual silver demand is industrial. Solar panels, electric vehicles, semiconductors, medical devices, defense electronics, aerospace components. The remaining 47% is monetary and investment demand, bars, coins, ETFs, institutional positioning. When you understand that split, silver's 19% crash becomes not just explicable, but predictable. The Iran war created a specific type of shock that hit both halves of silver's demand at exactly the same moment and from different directions. The industrial half was hit because oil at $119 per barrel is an inflationary shock to every manufacturing cost on Earth. When energy prices double in a week, the companies that buy silver for industrial purposes, solar panel manufacturers in China, chip makers in South Korea, EV battery suppliers in Germany, immediately pause or reduce procurement. Their cost structures have just been blown apart. They need to reassess. Industrial demand for silver, which accounts for more than half of all annual purchases, was repriced lower in a matter of hours. At the same time, the monetary half of silver's demand was hit simultaneously. The dollar surged. Federal Reserve rate cut expectations collapsed. Bond yields rose. The investment case for silver, a non-yielding asset that benefits from low rates and a weak dollar, was squeezed from the other direction at exactly the same moment. Silver, sitting at the intersection of both worlds, got hit from both sides simultaneously. That is why it fell more than gold. Gold has one engine, monetary. Silver has two engines. When both engines are damaged at the same time, the fall is not additive, it is multiplicative. Now here is what the standard coverage missed completely. The IEA reserve release, the event that is being reported today as oil news, is actually more significant for silver than it is for oil. Let me explain why. The reserve release is designed to do one specific thing: prevent oil from repricing the global inflation outlook so severely that central banks are forced to stay hawkish indefinitely. If the reserve release succeeds in capping oil below $100 on a sustained basis, which appears to be the intent, then the inflationary shock story begins to fade. And when it fades, the Federal Reserve's rate cut window begins to reopen. And when rate cut expectations recover, the dollar softens. And when the dollar softens, silver's monetary half restarts. At the same time, if oil is capped below $100, the industrial slowdown thesis that crushed silver's industrial half also weakens. Manufacturing cost pressures ease. Industrial buyers who paused their silver procurement begin to return. Both engines restart. Not because of one catalyst, because the same single event, the reserve release, is the catalyst for both halves of silver's recovery simultaneously. That is the mechanism. That is why the G7 reserve meeting that the market is reading as oil news is actually the most important catalyst for silver's recovery path that has emerged since this conflict began. The historical comparison that matters most here is 2022. When Russia invaded Ukraine and oil spiked above $130, silver crashed 23% in the first 3 weeks. Analysts who understood only the monetary half of silver sold it into the crash. The industrial half, which had been disrupted by the oil shock, gradually recovered as energy prices stabilized. By week 8 of the conflict, silver had recovered the entire initial crash and was trading at multi-year highs. The structural mechanism driving that recovery was identical to the one I just described. Energy price stabilization removing the dual headwind. The current setup is structurally analogous with one critical difference. The Silver Institute has confirmed that the 5-year cumulative deficit in the silver market now exceeds 800 million ounces. In 2022, there was no structural deficit of this magnitude building underneath the price. Every recovery in silver this time is amplified by a physical supply picture that is tighter than it has ever been in this bull market. Check every one of these numbers yourself. The Silver Institute publishes its deficit data publicly. The IEA reserve proposal is on their website. The COMEX registered inventory figures are released daily. Every input I have given you tonight is verifiable in 30 seconds. Now let me give you the bear case honestly, because it deserves a fair hearing. The bears will point out that even if the reserve release caps oil, the war itself has not ended. Iran's new supreme leader Mojtaba Khamenei has taken a defiant posture. Defense Secretary Hegseth said explicitly this week the war would not end until the enemy is totally and decisively defeated. As long as the Strait of Hormuz remains functionally disrupted, the industrial demand softening for silver is not fully resolved. It is merely paused. They will argue that 300 million barrels of strategic reserve sounds large, but is 33 days of Hormuz flow at pre-war rates. If the war lasts months, not weeks, the reserve is a bridge, not a solution. And they will argue that silver at $88 after a rally from $79.50 is not cheap. It is recovering from oversold conditions, not beginning a new leg. Each of these points has real validity, but the counter data is equally real. The COMEX registered silver inventory available for actual physical delivery stands at approximately 81 million ounces. Open interest, the paper claims against that inventory, represents nearly 3 times that amount. A physical tightness of that magnitude does not soften during a recovery. It intensifies. And Deutsche Bank's year-end silver target of $100 was set before this war began. The Silver Institute identified 6 consecutive years of structural deficit. These are not prices or forecasts. They are inventory data. They do not change based on Trump's phone calls or Hegseth's briefings. Now the price map. 3 levels that matter. The floor that must hold is $80 even. Silver tested $79.50 on Monday, found buyers, and has been recovering since. A sustained close below $80 would tell you that the war-driven inflation story has overwhelmed the reserve release narrative, and the dollar is strengthening further. In that scenario, the next meaningful support is $75, silver's pre-war trading range. That level must not break if the structural bull thesis is intact. The resistance that matters most right now is $90. A sustained close above 90, particularly if it comes with any softening of the dollar following a cool inflation reading or any positive development on the strait, tells you that silver has reconnected with both its monetary and industrial demand stories simultaneously, and the path toward the pre-war high of $96 is clear. Above 96, the chart is open air. There is no overhead supply, no previous sellers, no bag holders. The first target from there is 115, then the all-time high at 121. On oil, Brent's floor is $80. Below that, and the market is pricing a full de-escalation and Hormuz reopening within days. The resistance is $100, a level oil crossed above and then lost this week. A sustained return above 100 on Brent means the reserve release has been insufficient and the structural disruption thesis is reasserting itself. That is your map. Hold it, and do not mistake a resistance test for a reversal. Now let's look at what the institutional money is doing. The signal is not ambiguous. The SLV, the iShares Silver Trust, the world's largest silver ETF, recorded net inflows on 4 of the 5 sessions since the crash began. That is, the long-duration institutional money, pension funds, sovereign wealth funds, commodity allocators, using the 19% crash to add to silver positions rather than exiting them. They are not selling the geopolitical story. They are buying the structural supply story at a lower price. On the oil side, the futures market is in a structure called backwardation, near-term contracts priced significantly above long-dated contracts. This is the market saying simultaneously, severe near-term shortage but eventual resolution. Every barrel of strategic reserve oil that gets approved and announced moves the near-term contracts toward the long-dated price, compressing that backwardation. As it compresses, the speculative long in oil needs less justification to hold, and when that long begins to unwind toward the long-dated price, some of that capital will rotate into precious metals, including silver, which are priced in the same dollar environment, but have not had the comparable liquidity injection that oil is about to receive from the reserve release. Now let's make this personal and concrete, because numbers on a chart and numbers in an account are two different things. Silver is trading at $88.28 per ounce right now. If you are holding 100 ounces of silver, your position is worth $8,828. At the $96 pre-war high, the level where silver was before the crash, those same 100 ounces are worth $9,600. That is an 8.8% recovery that requires only the market to return to where it was 12 days ago. At Deutsche Bank's $100 year-end target, 100 ounces becomes $10,000. At the 150 target that the gold-to-silver ratio math at a ratio of 40 produces against gold at 6,000, 100 ounces is $15,000. Scale that to 500 ounces, $44,140 today, $75,000 at the ratio target. To 1,000 ounces, $88,280 today, $150,000 at the ratio target. Same metal, same ounces, just the structural reality of 6 consecutive years of deficit and a war-driven supply disruption catching up to a price that was beaten down by a temporary monetary headwind. Tomorrow morning at 8:30 Eastern Time, the US EIA releases its weekly crude oil inventory report. This is the most watched supply data in the oil market, and on any other week would be a routine number. This week, it is not routine. The inventory data will show how much of the strategic reserve announcement has already begun to move into the commercial supply pipeline, and it will give traders the first quantitative read on whether the 33-day bridge theory is holding. If commercial inventories show an unexpected build, meaning supply is beginning to normalize faster than the war's disruption is consuming it, Brent could trade back toward $80, and silver may face renewed pressure as the inflation relief trade kicks in more aggressively than expected. If inventories show an unexpected draw, meaning the Hormuz disruption is consuming supply faster than the reserves can replenish, you will see oil back above 95 before the session closes, and silver's industrial demand fears will return. That binary is your trigger for tomorrow. Watch the EIA number. And tomorrow on this channel, we turn our attention to gold. Specifically, what the February CPI reading of 2.4%, which does not yet include a single dollar of war-driven energy inflation, means for the Federal Reserve's meeting on March 18th, and what that meeting means for gold's next move. That is an episode you will want to watch before the Fed decision. Subscribe so you do not miss it. 1.8 billion barrels, the number that defined today's market. A reserve release designed to buy time while the world's most important oil waterway remains functionally closed. Silver at $88, recovering from a 19% crash that was rational in cause and is equally rational in its reversal. Both engines damaged simultaneously, both beginning to restart for the same reason. I'm James Harlow. This is The Right Chapter. It's never too late to get it right. Good night.